Good morning. My name is Brenden Rendo, and I'm with the Homes in Orlando team at Next Home Neighborhood Realty. And again, this is my associate, Joseph Dionne of Appli
Hey,
Home Loans. And this is good morning and welcome to the Orlando Real Estate Buzz. We are a weekly show that tries to bring information about the local real estate market and things that are going out that are affecting it. Today, kind of came up rather quick because I'm working with some different investors and we were trying to find some lending solutions that were different than the conventional market. And so I turned to Joe, said, Joe, this is what I've got. Do you have anything out there that can help us? And he was able to bring me a new program. And you're saying these programs are starting to become more relevant for the investors.
Yeah. So these programs have kind of been out for a little while, and they were really prevalent, or kind of, I say really prevalent. You saw them a lot more in the early 2000s, and then they kind of went completely away. But we're seeing a lot of investors, a lot of lenders. So our program is, the Investor Gateway. But it's basically all it is it's a debt service coverage ratio loan, or a DSCR loan. So you hear those terms, and I've been getting a lot of questions, a lot of people and a lot of investors asking, what is this DSCR? What is it? How do I qualify? Is it easier for me? Does it make sense? Is it hard money? And I think today we're just going to take a little bit of time to just dive in and talk about what this program is and why it's a benefit and who it's a benefit for.
Makes a lot of sense because investors are always looking for alternatives, and a lot of these investors, go back and they're self-employed, or it's a second type of job position. So we just can't go and do the conventional. Hey, give me 2 years tax returns, give me the bank statements, show me all this stuff. And a lot of them are trying to turn something really quick. So you got to find an alternative, and you got to be ready for them. Yep. When they do find, especially these days, the few properties that are available. So why don't we dive in?
Yeah.
And let's go through a little bit about the program.
Oh my goodness. You put together a PowerPoint.
Yes, I did. You know me.
Brenden is prepared to go. He's like, Joe, we're going to talk about this. He's prepared. Let's go.
You call it debt service coverage ratio. I call it cash flow. And that's the way I look at it. What's the cash flow of the property? Right?
Absolutely.
So let's hop in and let's go through who these loans are really targeted for.
Yeah, so these are investor focused loans. They're for investors. They're not like, you're not doing this loan on a primary property because, like you said, it's a cash flow. Like if you're living in the property, you're not cash flowing that property. They're geared for investors. So they're really geared in a couple different senses. People that have significant portfolios. Why is that important? Because Fannie Mae, Freddie Mac, they have caps on how many loans you can finance or have financed at any time. This isn't a Fannie backed loan. This is a Freddie Mac backed loan. This is an actual private portfolio type loan that investors are offering. So it's excluded from those caps.
So you can go above that. What is it? Five property cap?
So you typically see, usually, Fannie, Freddie, go to 10 depending on it. But usually you see that it's most investors, they kind of reduce it to 6 or 8 is what you see. Like big banks kind of lock people in for traditional loans.
Because they don't want too much exposure.
It's all about exposure. Exactly. And then you have, traditional, you mentioned here, borrowers that don't qualify for traditional or full income documentation. And this is where like the bread and butter is like, these programs it's qualifying on the property. So it's not looking at a lot of the other pieces. Like, there's things that, and then you mentioned with excessive amounts of debt obligations. Again, if it's only looking at the property, right? It doesn't care about what their income is, what their debt to income ratio is. It doesn't care about their obligations outside of what is this property going to do?
Okay. So let's hop over to the next one and let's talk about how does it.
Yeah. So, I mean, it's super easy to qualify, and it's a very basic, program when it comes down to the science and the nuts and bolts, right? It's what is it renting for? As
Okay.
long as that is, divided by, or excuse me, the principal, interest, tax, and insurance. So the total monthly obligation divided by the amount it would rent for.
Okay.
If that number is greater than 1, it qualifies.
Okay.
And here's kind of the trick. If it's less than 1, sometimes it still qualifies.
Okay. Well, are you looking more at the asset then? The little, strength of the borrower?
Yeah. So what it does there, because again, remember, like you have your Fannie Mae and Freddie Mac, those traditional, like your traditional conventional finance properties, right? And
Yes.
it's all rules. It has to fit within these boxes. We have, this huge manual, the seller guide. And if it doesn't fit within those rules, it doesn't qualify. Well, with these programs, it's portfolio, meaning the bank is the one funding it. Like they're holding it.
So it's almost like it's almost like a private money.
Exactly. In a roundabout, kind of like private money, which means what? That there's exceptions granted oftentimes. So maybe the DSCR might be lower than 1. And they look and they say, you know what, this bar has got bigger assets. We're going to take on this risk. Here's what we're going to do. And we'll counter a proposal. Or we get a little bit creative, because we're not just looking at 30-year fixed options. We've also got interest only options potentially that can get that payment. And again, it's
to where it did fit back above. Okay. But when you say they may counter, what you're saying is sometimes maybe you went in at 20% down.
Yep.
But they may come back and say, well, we're a little bit under the 1. If you're able to do 25% down, we can make this loan happen.
Exactly.
Something like that.
Exactly.
Okay. Which is nice, because these days, when you're in a conventional loan, it's like, it's approved. No, it's not. It's approved. No, it's not.
Yep.
there's no going back to the underwriter negotiating anything. It's no, you're not approved. That's it. Bye. So let's go through a scenario about debt service coverage ratio.
Yep.
Because one of the things today, which is great for investors, is rents have just shot through the roof. So that when you're looking at your what we call debt service coverage ratio, where you may have been renting a property at $1,200, 2 years ago, you're probably getting $2,000 for that thing.
Yeah, that's craziness.
I don't know how people afford it.
That's for another conversation.
Yeah, that is true. Keep me on point.
So I think when you mentioned you've got rent schedule and appraisal, so you're saying 2,000. What do you think? This is like a 300,000 price point? I think is what we talked about.
Should be right in that ballpark. About a 300. Probably. I would assume 20%, because I know a lot of investors. That 20% mark is something that a lot of them will feel comfortable with as well. So that's what I worked my numbers off of.
Yeah. So and we have it's very simple. As long as it's greater than the PITIA, I say $1 more. And I think that's, like $1 more is just as easy. If the PITIA is $1,999 and it comes in at a $2,000 rent, it qualifies. I mean, realistically, it's the ratio itself has to be over 1, which means that it could be, the proposed rent could be $1,999.01. And if the monthly obligation is $1,999 and no cents,
you're good.
It's over 1. It qualifies.
Yeah.
So,
which is interesting, because as an investor, we used to look at it and we tried to keep it at 1.2. Okay. But with increase in costs, if you're getting 1%, the 1 ratio, you actually feel like you're doing good these days.
Yeah.
As an investor, if you can keep it above the 1 and you're not having to, come out a little bit every month, you're actually, these days, you're doing good, just because of the increased costs of carrying it.
And we have the increased cost, but really what makes it beneficial for the investor right now is that increase in appreciation now. Yeah. Like your property, if you're breaking, quote unquote, the month to month, like if it's breaking even, so to speak, but you're just holding that property. I mean, year over year, like the Metro Orlando was the average home, I think,
30% last year.
Yeah, that's craziness.
Yep.
So, taking that example, right? And we sit there and say, all right, 300,000 purchase price, 20% down. So 240,000 loan amount. Yeah, we won't go into details. I think we estimated this rate was, 6%. This isn't a qualification for, an actual mortgage or anything. This is just an example. So principal and interest, 1438.92, taxes 31,250. That's an estimate based off the norms. That gets you a total payment of 1876.42. And this is kind of like your average $300,000 property. This is what you would be looking at with 20% down. And you're telling me that typically in that price range, we're getting 2,000 plus for rent.
Yep. And we're for people to understand where we're getting that rent numbers. What happens is an appraiser will go out and he'll do what's called a rent schedule. So he's going to actually go around that home just like you would in the normal appraisal process, and he's going to figure out what rents are going for. And that's what we're looking at, and that's where we would get that $2,000 number.
Yep. Yeah, and that's on a purchase transaction, exactly. Just like an appraiser goes out and gives you that value, the appraiser does the rent schedule as well, which they look at the recent comparables for properties that are rented and determines what this property, the subject property, would yield in rent.
Yep. So again, just got to keep it above that 1 ratio. And here you see we've actually got a little room so that maybe the insurance comes in at 150 or 175. We're still good. Room. You still got room. Excellent. Oh. Well, let's just kind of sum it up for everybody. Let them know, what are some of the features and, what are some of the things that you can do with it as far as like, I know a lot of investors may want to take some cash out, things like that.
Yep. Yeah. So I definitely think this is kind of getting a little bit more geared to some of like kind of what our program features, and, but a lot of investors have similar features, or, banks might have similar features or so forth. But some of the biggest pieces, is, obviously these are 30-year fixed, but there's an interest only option as well, which is very attractive because that sometimes that increases that margin. If you're holding on to a property and so forth, and you expect to hold it for 5, 6, 7, 8 years, the interest only might make sense for you.
Especially with the appreciation that's going on.
Exactly. And then like what's kind of cool here is we can do 15% on this program, which is really, really hard. Like you've always been able to do 15% with Fannie and Freddie, but like a lot of banks don't allow it. And Fannie and Freddie are extremely picky with that 15% down. This program, they'll do it. And I actually like sometimes the 15% down may actually be better in pricing than 20 or 25% down. It just depends on the investor in that given day, because it changes constantly. And it's all about buckets. It's all about exposure. So if they have the bucket with 15 and 20 and 30% down, and they've got nobody pricing up and putting anything in that 15% bucket, they're going to try to make it more attractive.
Make it more attractive.
Put something there.
Yep.
So that's a really, really cool one. And what happens with this, like the whole point of a DSCR, right, is simple. It reduces the underwriting, reduces all the kind of pieces that you need to do, but it also keeps more cash in hand for the investor, which means they might be able to do, if you can do a 15% down or a 20% down, you might be able to buy 4 or 5 properties with the same money you would have plopped down on on one property if you paid cash.
Yeah. Yeah, I know, because a lot of the what we would call hard equity, hard money loans. A lot of those, I've got a friend who does all that, and they're still sitting at 30% down. So doing the 20 or even really 15's unheard of. Again, you're right. I've just taken that and divided it into 2 houses instead of just 1 house.
Yep, exactly. So, and then, you mentioned the cash out refinance, like, some investors already own the properties or they own a lot. This is a big one, and you can do as much as 3 million. I mean, I haven't seen it go that high, but I have investors that are on the back end willing to go up to 3 million on a cash out on this program, which is crazy, and it's awesome. And it just adds a lot of funds. The next piece that you listed here, we can close in an LLC. Almost every investor that does this program, because again, this is a non-QM, this is a portfolio type product. They're gonna allow to close in an LLC, a corporation, a trust, and again, the credit, like they're looking at they're reviewing your personal credit. The mortgage is going to be tied to your personal credit, but you're able to close into those LLC and corporations.
Which is great because protection for the investor.
Absolutely.
That's exactly why you set them up, is protection. So that if something happens, they don't come after you personally.
Exactly. Credit scores as low as 600. Again, portfolio private loans. You're not going to get a 15% down option if you're at 600 credit score. You're going to have but we're able to look at scenarios, and credit isn't the determining factor. It's not a hard no if you're a 650, a 660. I've got a lot of hard money or portfolio investor programs that before this, that they were like, hey, we want 30 to 40% down if the person has a credit score under a 660. This is not going to penalize you to a great extent for that. And it's all about being able to evaluate and work with someone that's able to really talk to that bank and really figure out what options are available and where can we evaluate this. Now, probably going to have a higher interest rate if you've got a lower credit score. Those things kind of just work that way. Lower credit score, interest rate's almost always going to be higher. So single family resident, condo, 2 to 4 units are allowed. Well, why is that important for you? This kind of opens the gamut for you guys.
It does. Well, especially here in the Orlando area, because there are so many condos that investors own. And a lot of programs that I've seen don't do condos. And condos are still, my gosh, if you can find a condo in that $150,000 to $200,000 price range, you're getting $1,800 a month on a 2-bedroom, 2-bath condo. I just had a conversation with a young lady who she's in a 1-1 over here in Sable, and she's paying $1,800 a month. And she's like, can you help me? You think we can save some money if I buy a house? I'm like, yeah.
Oh my goodness.
I'm like, oh my gosh. That's nuts.
So to kind of compound it, this is the big one. We touched on it before. Unlimited amount of properties owned. The reason why this kind of works is because they're not looking at what's financed before, and they're only looking at that property. Now, every investor has exposure limitations, but whereas Fannie has general rules that's going to apply to all loans that's insured by them, this program's not. They're going to only care. I've got investors, and I've got multiple back-end investors and lenders that are sitting there saying, hey, I can do this program, and I can sit there and be like, if one has exposure with 5, I can bring 5 to them, and then I can go to the next one and bring 5 more to the next person, and we can build, a portfolio can be built that's pretty significant through this program.
Gotcha.
So, I think that's really, really super important too. First-time investors are allowed. This is a big one. A lot of these portfolio loans, how many people are trying to break into being an investor? And then they're they've got they've done an amazing job. They've saved up, but they still work their W-2 job. Their expenses aren't there. Their debt to income ratios aren't in line to make sense to do it, but they've got a large amount of assets, and they want to break into this mold. A lot of portfolio products that are investor geared don't allow first-time investors.
They don't. This goes back again to my friend here in town who does the private equity hard money type loans. They actually want you to put together a schedule of the projects that you've done, and you actually have to show them that you've done something. If you haven't, boom, you're out. You're out. They won't even touch you. It's and again, it goes back to well, how do I get started then? Where do I find my money? This is great.
Yeah. So, I think this is really, really awesome. And this isn't an all-inclusive. These are some of the benefits. If you really if someone is ready to take, or they're curious to find out more information, definitely connect with myself or reach out. If you've got someone that and you're working with, ask them about these programs, find out the information, and look at your scenario and find out, is this program right for you or not? I will tell you, in the grand scheme, these are, their portfolio, they're super easy. We can order appraisal before disclosures are signed. We can really with these loans, you may, some investors might not even require disclosures be signed because it's basically portfolio private money in a roundabout way. And and it really just opens up timeline. It's get title, get appraisal back. You know,
Mhm.
they're going to look at your credit report because you know, a lot of investors probably, you know, if you're late on your current mortgage, you're probably throwing, you're not going to be setting an example that you're going to do well on this one. But there's
Mhm.
very basic guidelines, and I can talk to anybody that's interested to learn more information. I can tell them about my program. But again, just know these terms when you're ready to invest, or if you're working with someone else, you know, and you're
Yeah.
curious about these type of programs. Note DSCR, debt service coverage ratio.
Yep.
Ask these questions because it can open up the door. And a lot of people don't know that these programs exist, so they don't even ask about them.
Yep. Yep. And I mean, even if you're paying a 6% interest rate, my
Yeah.
gosh, when I used to write hard money, we were at 18% in 3 points, and we
Yeah.
got it without question.
Hmm.
You
Yeah.
know, I mean, if you're at 6% and you're cash flowing, go for it. You
Yeah.
know, that for an investor, that's the bottom line. Am I cash
Mhm.
flowing positive? That's what you want to see.
Yep. And a lot of what, you know, exactly. And that's the big key. And if you look at the market right now, Fannie and Freddie, like if it's at 6%, like, and this is like I priced up some scenarios where it's been somewhere in that range, you know, like even a little bit lower, a little bit higher. When you have those type of scenarios, like it it's really not it's a really attractive option. If you've got no other way to go, it's absolutely phenomenal.
Yeah.
But with sometimes, you know, and I've had investors that have come to me and they own 14 properties and they just don't want to deal with the paperwork. That
Yeah.
one, you know, that 1 to 2% more than what Fannie Mae rate might be
Yep.
is that hassle isn't worth that time.
Isn't worth it. Yep. Yep. Understand completely. Well, I appreciate it, and I appreciate you telling about this for my investors. I know we've got at least one or two that we're looking at right now. And any questions, again, feel free to reach out to me. Feel free to reach out to Joe, except he'll be on the beach in Miami.
For a day or two, for a day or two.
But I know he keeps his phone handy. So, all right, wonderful. Have a great time, and we'll see you again next week, Joe. Bye bye.
Thanks so much, guys. Have a great one.